Hello and welcome to the Tax Life. I am your host, Jeffrey White, a 30-year tax professional, business owner, MBA grad, and how do I say this? Tax geek. And that could maybe give me an explanation. But anyway, how you guys doing? Welcome. Tonight's topic is a topic that's very interesting, and it's interesting because a lot of people, taxpayers, people in general, they hear stories about the one percenters, the really rich people, wealthy people, and how they pay no taxes or they pay very little taxes. Have you ever wondered how that happens or how that comes about? If so, leave a comment if you ever wondered about that. But tonight we're going to talk about and give you some insight in how something like that can actually happen in our tax code, and how you might be able to affect your tax life just like some of the one percenters. Tonight's topic is how the tax code rewards business owners and investors. Okay. And let me ask you a question before we get started. Who do you think makes and pays more in taxes, let's say? Employees, business owners, investors? Well, you might think that it's whoever makes the most. But let me tell you a secret. It's not how much you make that really matters. It's how you make it. Okay? And I want to give you an example. Imagine two people. We're going to use these two people throughout the session. And their names are Kevin and Lisa. Now, Kevin is an employee, W-2 employee, makes about $100,000 every year. And Lisa's a business owner, and she makes also $100,000 a year. At tax time, they sit down with their tax professional or tax preparer. They do their taxes, and Kevin ends up on a tax bill of $18,000. But Lisa only pays $6,000. Now, how does that happen? You might ask. How is that possible? And I'll tell you how that's possible. Did Lisa cheat the system? Did she do something she wasn't supposed to do? No. What Lisa did was she worked with a tax professional, and her and the tax professional worked together because they know the code, the U.S. code, and they had a plan, and they paid, 1/3 less taxes than Kevin. It's not necessarily how much you make, but it's how you make it. Now tonight I'm going to share with you 3 tax secrets, let's say, and maybe 3 how-tos. Number 1, why business owners and investors actually pay less taxes in a lot of cases than employees. I want to talk to you about, number 2, some specific advantages that business owners and investors have over people who earn a salary and are W-2 employees or wages. And then number 3, I want to tell you how you can start to take advantage of some of the same benefits that are exercised through the tax code that Lisa does. And these tax laws will positively affect your tax life. So have you ever felt like you're paying too much in taxes? I know at one point in time I did. If you're a business owner or investor or W-2 employee, if you've ever felt like you've been paying too much in taxes, leave me a comment in the message box, and I'd like to hear what you have to say. Now, I want to have as many comments as I can to be able to answer questions. But if you stick with me to the end of this session, we're going to be able to find out how the wealthy people, the 1%ers that we talked about earlier, they don't necessarily work harder and make more money or save on their taxes. They're a little bit savvier and they work smarter, at least when it comes to taxes, okay? Let's talk about something that maybe many of you maybe not have considered, okay? It's the type of income determines a lot of times what your taxes are. And the IRS says that not all income is created equal. And as a matter of fact, the IRS says that they categorize two different types of income. There is earned income, which is usually taxed at a higher rate and has a higher tax burden. Earned income would include things like your wages, salary, maybe even if you're a solo entrepreneur or a sole proprietor, you might pay some self-employment taxes, which is taxed at an ordinary tax rate or even payroll taxes. All right. And then the second type of income is leveraged income. And we actually talked about what leveraging was in a prior session. But leveraged income usually is taxed at a lesser amount, lesser tax burden, lesser tax liability, and that includes income that is made from business profits, could be capital gains, it could be dividends, it could be real estate income, and it also could be investor income when the investments are made in tax-free investments. So these are the two categories that the IRS looks at, and they are taxed differently. And in some cases, the tax burden for leverage income could be as low as 0%. And that is giving you some insight into how some of the 1%ers pay little or in some cases no taxes, okay? So if you did not know up until this point the different types of income, again, earned income and leverage income, then you've already been playing and living your tax life at a distinct disadvantage, okay? So now I want to tell you how the IRS treats business owners and investors differently. Let's talk about the same example with Kevin, the W-2 employee. Again, that same 100,000. Now, Kevin has available to him very few deductions and credits. And after he takes those deductions and credits on his tax return, he still has to pay taxes on all the remaining income. Whereas Lisa, the business owner, same $100,000 to start with, but Lisa gets to deduct many, many more business expenses that allow her to lower her taxable income, and then she pays tax on what's left over. So Kevin pays taxes on the majority of his income, while Lisa has the ability to drive her income down with business expenses. You see the difference? Okay. Lisa controls her income, whereas Kevin, he has very little control. Now you're starting to see and get the picture. So now that you kind of understand how the tax code favors business owners and investors, let's break down and give you some actual benefits the IRS gives them. And trust me, when we're done with this, you're going to want to put some of these benefits and advantages for tax purposes in play in your tax life. First, I want to give you 10 ways that the tax code that we have, our tax system, rewards business owners and investors. Number one, like we said in the previous example, business owners get to deduct many, many business expenses prior to being taxed. Employees don't. Imagine writing off your laptop, your utilities, your cell phone bill, maybe some travel expenses, all before taxes, while the same person um, makes maybe the same income, W-2 employee, they have to pay for these things with after-tax dollars. So they get the income, they get a few deductions, maybe a credit or two, and now they're using and buying and experiencing those same things, but they're buying them and experiencing them with after-tax dollars, which means that they have expended those things at a greater proportion of their income than the business owner. Number two, investors can make money through capital gains. And if you remember, capital gains are the difference between when you invest money and when you purchase the investment and then that investment grows. The difference between that, when you sell that investment, is capital gains. And those capital gains are subject to taxation. The cool thing, though, if you're an investor and you invest and you get capital gains, when you pay capital gains and you pay, let's say, on a long-term capital gain, which is holding that asset for a year or longer, now you can pay as little as 0%. Okay, so you can see how that 0% could be a much different amount versus maybe someone that is a W-2 employee and pays 15, 22, 37%. Okay, which one do you think is a better deal? All right, I think definitely you can see how the business owner and investors are starting to get better deals. Number three, business owners can write off their home office while employees cannot. And Lisa, again, that business owner, she works from home, let's say, she can deduct a portion of her utilities, her rent, and even her internet costs, while Kevin, he cannot do that. Okay. Number four, depreciation. If you remember, depreciation was the ability to write off and then take an expense deduction on a business asset that you may own in your business over a certain amount of years or a set amount of years. Now, the business owner is allowed to do that and deduct the business asset over a period of years. Example would be a real estate investor has a home and they renting that property out, and they can get a deduction for the next 27 and a half years every year, called depreciation deduction every year, and they don't have to spend another dime after they purchase that property, and they get that deduction year in and year out. Whereas someone that has a W-2 or a salary will not get that benefit. Real estate investors can also utilize a tax law called Code 1031 and use a 1031 exchange. And what that 1031 exchange will allow them to do is take a real estate property, make a sale on it, and then instead of paying the capital gains between what they bought it at and what they sold it at, that now that business asset has the ability, and that taxpayer now has the ability to take the capital gains and invest that capital gains into a new piece of property, and now can defer and not pay any capital gains. Now they're paying 0% of their taxes, and now they're taking that one property, and now that property might be single family resident, and now they buy another single family resident of equal or greater value, maybe even a duplex, and now you can see how that investor, that real estate investor, now did not have to pay capital gains tax on the sale of that property, and now is taking the difference that they might have spent paying the government, and now maybe buy a duplex, and now instead of receiving rents from one single family home, they might be able to receive rents from a duplex or maybe even an apartment building. And another example would be number 6, business owners can shift income from the business to family members of the business owner. Okay. Example would be, we utilize this in our practice all the time. we'll have a business owner, and when we start doing tax planning for them, we'll find out the ages of their family members, and if they are of the allowable age for that particular state, we'll draft up the proper job description, and we'll put their teenage son or daughter maybe as an employee to do the required tasks, the necessary tasks that are commensurate with their abilities, but they now work for that business owner, and now that business owner, the teenager, is taxed at a lower rate, and then as a whole, the whole family now has a lower tax liability. And then on top of that, the money that the teenager makes from working for their parent or parents, they can now take that money, put it into a Roth IRA, which is a retirement account that grows tax-free, and the interest in that grows tax-free over years until they pull it out. So that teenager can start saving for their retirement at an early age. So you can see how, in that particular case, that particular strategy actually has two benefits. Number 7, investors can invest and earn money in tax-free municipal bonds. Okay, so a municipal bond it's a loan, and it's a loan from a taxpayer, or let's say a citizen to a county or a state or a city, and instead of the city taxing the municipalities participants, the city will ask taxpayers and the citizens to loan them money in the form of a bond, and they call that a municipal bond. And then the city or the state or the county now uses that money to maybe build a school or improve the roads or build a park. So what happens is, if you're an investor and you invest in municipal bonds, you actually can grow that interest that would typically grow tax. Let's say if you had that money in a CD or savings, typical savings, then you'd have to pay interest every year on the pay taxes every year on the interest that savings account make. But if you take that same money and invest it in a municipal bond, then now the money that you put in that municipal bond now grows tax free year after year after year. And then you also can get benefits, because they will pay you interest on that bond periodically as well. And in some cases, you pay zero taxes on federal, on the municipal bonds. On federal, you pay zero taxes, and also in some cases, you get to pay zero taxes to the state. So you can see how interest on a municipal bond that you make is now tax-free. It's a lot better and more advantageous than the interest that you might have on a money market account or a CD or a typical savings account. Okay. Number 8, business owners can use retirement accounts like a SEP IRA or a solo 401k. Now, these are real similar to your typical IRA that typical taxpayer may have at the local bank. The 401k, the SEP solo 401k, is similar to a 401k that you may have at your job. The main differences with a SEP IRA or a solo 401k is the amount that a business owner can invest in or put money to the side in is much greater. I mean, much greater. And it really all depends on how much the business makes. But let's say a self-employed person, business owner, can contribute $50,000 to their solo 401k and immediately in that tax year reduce their taxable income dollar for dollar. So let's say if the business end up making gross $150,000, then and they put 50 of it aside in a solo 401k, immediately that they can now only be taxed on 100,000. So you can see how that advantage is given to a business owner, and a W-2 employee, they're maxed out at about $6,000 per year right now and putting money in their 401k or their IRA. Number 9, investors can qualify for lower tax rates on qualified dividends. So this is where the Warren Buffetts and the the rich people that are wealthy people that are business owners are invested heavily into business. This is where they can take advantage. Well, not take advantage. Actually, they could just use the advantages that the tax code is written into. But a qualified dividend will be maybe exchanged for a salary. Let's say a CEO is making a salary of $1 million, and then they decide to take a portion of that in the form of dividends. So now when they do that, they exchange potentially a 37% marginal tax rate on the W-2 or the employee income as a CEO, and now they exchange that for up to maybe 0% on qualified dividends, because again it's taxed at a lower tax rate because it's a different type of income. It's leveraged income versus earned income. So now you start to see the difference. And then finally, number 10, business owners can use a section of the IRS code. It's called Section 179, and you can use a Section 179 deduction to deduct large equipment purchases. So in our practices, we have a lot of business clients, and then some of those business clients have trucking business, transportation companies. So periodically, one of our business owner clients will buy a new truck or add a new truck to their fleet, or take one out of service and put a new one into service. But let's just say that truck costs them $75,000, tractor trailer kind of truck. They can automatically, by choosing to utilize the Section 179 deduction, they can automatically expense the whole $75,000 that they paid for that truck in the first year that they purchased it. Okay, now that's $75,000 directly going against their top line revenue. Now here's the cool thing: they don't even have to have paid the full $75,000. They could be financing the truck, but as long as that purchase price of that business asset, in this case the truck, is $75,000, they can actually tell the government that they have purchased a truck for use in their business, $75,000, and they will get that deduction if they choose to use that under IRS Code Section 179. Okay, so again, you can start to see how things will be advantageous for the business owner and the investor. Now these aren't what people commonly talk about. These aren't loopholes. Matter of fact, there's no such thing as a loophole. The reason why it's called a loophole is because the people that aren't taking advantage of those things think that maybe, like we thought, maybe Lisa was cheating the system or had a loophole. This is not a loophole. Those aren't loopholes. Our tax system is just geared and slanted toward business owners and investors. Okay, that's just how it works. That's how the system is designed. So now the question comes up is, well, if you're not using these, then why aren't you? And then if you're not, and you know you're not, then what can you do about it? Okay, so this is where I like to say the rubber meets the road. So if the tax code give you these advantages and we're not using them, or why doesn't everybody use them, then what do we need to do about it? What can we do about it? The reason why most people aren't using, one, the first thing is they don't know about them. And then two, they're not positioned to take advantage of them. So these tax laws that provide advantages, direct advantages to business owners and investors, if you're not taking advantage of them, that's just because you're not positioned to take advantage. And this is where these lessons are scheduled, and why they're scheduled. And what the hope is that through the attention that is drawn to your tax life and planning, and then the attention that is drawn to the tax advantages that are available to you if you position yourself, then that's how you start to be able to become um, uh, beneficial to benefit from the tax laws that are written this way. So the law of positioning. Now the law of positioning we talked about a few sessions ago, and for those one percenters that we talked about, the way they think about the law of positioning is that most of those people they don't wait until they're ready for a situation to come. They put themselves in position ahead of time, and they put themselves in position to take advantage of opportunities that haven't even arrived yet. So in this particular case, if you're a W-2 employee right now and you're paying and you're in the highest uh, category of taxable income, it's not a coincidence. It's just that the system is structured that way, and you have to reposition yourself. Okay, so this is where once we brought things to our attention, we now have to be um, intentional if we want to take advantage of the tax code and the system that is the system that we're operating in that's guiding our tax life. You don't need to quit your job or have millions of dollars to invest, but you do need to start making intentional moves that will shift your tax life into a position where you can start to take advantage of the tax code. And that's what tax savvy business owners do. And they position themselves to win, not just for tax savings, but they position themselves to win in various aspects of their life. Um, Somebody is asking the question: what expenses can be deducted as a Door Dasher or an Uber driver? Okay, great question. So let's say you decide to reposition yourself or position yourself to try to take advantage of some of the tax laws that are skewed toward business owners and investors. And you decide, okay, I got a few nights available to me, and I don't mind driving. Matter of fact, I like driving. You can listen to the music. So you want to do some DoorDash or even an Uber driver. And we have many clients that do that. So what tax advantages would be available to you? So just like we talked about Lisa, that business owner, now you can start looking, and now that you're a business owner, you say you sign up and you start to use your car and you start to do DoorDash. So the first thing, and probably the biggest expense that you can start to leverage is the automobile that you're driving. Okay. And you could use that automobile and leverage it in a couple of different ways. I'll just give you a quick couple examples. You can take the actual expenses that are incurred for in using that automobile to do the DoorDash or the Uber driving. Okay. And when I say actual expenses, you can actually take that same depreciation deducted that I talked about earlier that a trucking company might do on a $75,000 truck. You can do that same type of deduction or depreciate that asset, which is the vehicle that you have that you're using to do the Uber driving or the door dashing. Okay. So whatever the value of that car in that year that you put that car in service, if you decide that you want to use the actual expenses, now you take the value of that car and you'll get a depreciation deduction. You could use the Section 179 deduction that we talked about earlier, or you can actually take the value of that car and divide that value and get expense deductions for up to 5 years. And you can front load it this year, 2020, well, tax year that we're doing for 2024, the front load portion was 60%. So you got one section 179, 100%, or you could do 60% and then take the remaining 40% and spread that over the next 4 years. So that's just one example. And then with that actual expense, you can actually write off gas that you use to do the Uber or DoorDash. You can write off the portion of the insurance. Now, if you use that car solely for DoorDash and Uber, you can write off 100% of these expenses I'm talking about: the gasoline, the insurance, the maintenance on the car. We're talking about oil changes and tires and windshield wipers and whatever maintenance you might have in that given tax year. So you can start to see now how leverage income and being able to take all these deductions against the income that you made from the Uber and the income that you made from your W-2 can start to be really, really powerful. Okay. And that's just one example of some of the strategy and also some techniques. But if you don't know what they are, then you can't take advantage of them. And then if you take advantage of them or try to take advantage of them without the proper record keeping and without the proper documentation, then you're subject to having those deductions and those expenses disallowed. So you want to be really careful, and you want to, in my opinion, at least initially, employ the services of a tax professional, a planner, or a strategist who knows how to put you in position to, or to reposition you to take advantage of these things, and maximize the utilization of the tax laws in your favor. Okay, so again, we just talked about positioning, and again, you don't have to quit your job tomorrow or make $1 million or invest $1 million, but you do have to be intentional, okay? And you do have to, start moving in that direction. Again, all these lessons, the lessons that I've done in the past, the lessons that we're going to do in the future. Sometimes I know that if you're a loyal watcher, listener, you may think, man, this is a lot of information to know. And I understand that. And again, being a 30-year tax professional, I didn't learn all these things overnight. And that's why, again, I'm of the belief, if there's things that you don't know that you're interested in that have been brought to your attention, and there are professionals that can actually help and guide you in that direction, then you need to take the time, spend the money, and then over time you become a pseudo expert yourself after doing things, yourself with the help of a professional. So again, you can see these are examples of how business owners and investors have the tax laws skewed in their behalf. Okay, and the question is, right now in your tax life, are you playing chess and being strategic and making moves and playing offense and defense, or are you just playing defense and being reactive and coming to your tax preparer once a year, slapping a whole bunch of papers down in front of him or her and saying, hey, do my taxes, hey, give me back a large refund? And if you're doing that, I believe you're playing the game, the tax game. You're living your tax life at a disadvantage. Okay. So with that in mind, what exactly, how can you start to make the shift today? All right. Even if you just want to get started. So let's talk about how to take advantage of these laws that work in your favor that the business owners and investors get. All right, you might be thinking, okay, it's great for them, but I'm not them. I'm not in that position right now. But the good news is, you can be in that position, maybe not right away, but you can start to reposition yourself, and start right away. Okay, so I'll give you an example. If you're a W-2 employee, okay, and we're going to utilize the law of position, or you can say reposition. But if you're a W-2 employee, here's 3 things that you could do right away to get started. Okay, start a side business. Okay, and we just talked about a side business, Uber or DoorDash, or in my case, when I have a tax client that comes to me for tax planning services, I like to ask a few questions. One of the questions that I ask is, what do you do for a living? Okay, because I ask that question because I like to know what my client, my tax planner client, what are they already an expert in? Okay, because I believe that if you're already an expert of something and if you want to start a side business, then one of the best ways to have that business be given credibility automatically is if you're doing something in your day job, your W-2 job, then is there an offshoot of that you can do on the side? Is there a derivative of that you can do on the side? Or I like to ask my tax planning clients, what's your passion? Okay. What are you passionate about? A lot of times it's really good for a person if they have a passion to try to do that on the side, because once again, if you're passionate about something, that means you have a certain level of knowledge and maybe even expertise in that, and that will give you automatic credibility when with the agencies like the IRS and the state. So yeah, start a side hustle, um, and you'll start to leverage the tax code, because now you can start to get some business deductions and utilize those to bring down your taxable income, and you start to leverage and use the law of leverage on your behalf. Number two, you start investing in the stock market. Now remember that one example we talked about capital gains and the difference between capital gains and the capital gains tax rates, which are much lower for long-term or even short-term capital gains than ordinary income. Okay, so when you become an investor, we talked about one investment you can have is municipal bonds. Okay, so now you start to take some of your income that you would normally take and maybe put into um, a money market account or a savings account, and maybe now invest in some municipal bonds at 0% interest that you're taxed on, and then you're getting interest on that bond, and they're paying you that interest maybe semi-annually, and now you're making money on that from an interest standpoint and not being taxed on it. And then the cool thing about bonds is when that term of that bond is over, you get your money back, the whole amount of your initial investment, and you have the ability to now take that money and either reinvest in that same bond if it's still going on, or find a new bond. But you continue the cycle of tax-free investing, and you start to see your money grow. And now you start to be a participant because you now positioned yourself to take advantage of the tax laws. And then the third thing, if you're a W-2 employee, you need to look into real estate investing. Now, I particularly love when I get a taxpayer, a client that would like to be a tax planning client, and they have real estate already, or they want to invest in real estate. Because if you remember in that one example, how you can buy a home, rent it out, obviously, you receive rents as income for that, but you also get that depreciation deduction. And in a lot of cases, the depreciation deduction that you receive over the life of owning that property is so large that it will wipe out or zero out the positive income that you got or the positive cash flow that you got from renting out the property. So now you got a property asset, okay, which is probably, if history continues to repeat itself, that asset's probably going to grow over time. Real estate usually does that. Takes dips every now and then, but it still creeps its way up. Okay, everybody knows that. House my mother bought when we were kids was let me see, $14,000, and by the time we sold that house, it was worth $400,000. So time and appreciation, they go hand in hand. But that same investment, the rents that you received would be necessarily zeroed out by the depreciation deduction. And remember, the depreciation deduction is an accounting transaction, not an actual dollar for dollar. So if you want to get in the game and position yourself, look into real estate investing, because it comes with huge tax advantages, and then you can create wealth at a much more accelerated pace. Because an example would be, again, that 1031 where they exchanged the sale of that first property and bought another property. Well, they just were able to forego paying taxes. So that money that they didn't have to pay in taxes, now they can allocate that same money that they set aside to pay taxes. Because they did the exchange, they didn't have to pay taxes. Now they can take that same money and buy a second piece of property. So now you can start to see how the pace of your growth of your wealth can accelerate just by taking the tax savings that you have and investing in another tax savings vehicle. And now that same vehicle that saved you taxes also appreciates, so your wealth is appreciating. And this is how those 1% get to be the 1%. Well, not all of them. Some of them, they got old money, family money, but the folks that are coming out now, you can look into somebody like, what's his name? Rich Dad, Poor Dad. I forget his name, but you can see how taking investments, using real estate, and then taking the money that's saved from the real estate and investing in another piece of property can now accelerate if you do that on a periodic basis, once a year, every other year. I just had a client talk to me today, and he's got 4 pieces of property, and he leveraged. Again, that word leverage is cool. And the name I was thinking about for Rich Dad Poor Dad was Robert Kiyosaki. But the client I had today actually he has 3 properties. He took some money off of each one of the properties and took that money and then put it down on a 4th piece of property. And again, that was all about being able to leverage. Okay, he still owns the other 3 properties. He just pulled some money out of the appreciation of that asset and bought another piece of property. So you can start to see how a domino effect or a snowball effect can be created in investing once you get positioned or reposition yourself. Okay, now if you're already a business owner, but you're not fully playing in the game as far as taking advantage of all the tax laws that can benefit you, maybe because you're not planning, or maybe because you're operating the business and you're doing what it takes to run the business, but the back office part of your business, the details and the record keeping and the planning, all that may be suffering, but it's not too late. But you can play in the same arena that the 1%ers are, maybe at a smaller, obviously dollar amount to get started. But again, when we talk about, and when I ask after every session, well, what's your dream? This is really about playing the long game. So if you're already a business owner or an investor, you got to maximize your deductions. And a lot of times I'll get clients when they first get started with us that don't know that they can deduct certain things, or they have an inkling or an idea, but they don't know how to actually execute, or they don't know how to leverage the tax code and what I call write things up so that maybe a personal asset can be leveraged to be a business asset. Okay. So, but you want to maximize your deductions. You want to keep great records. If you need somebody to help you keep records, to get somebody to help you keep records, it's worth it. Electronic bookkeeping or record keeping system, but take the time, take the money, because at the IRS level or at the state level, if you don't record it and you take it as an expense and you can't back it up, then it didn't happen, and they will take it away from you and change your whole tax situation. So keep superior records and track your expenses, and deduct everything legally. And if you don't know what you can deduct, then hire a professional to help you plan and execute. And then number 2, if you're already a business owner, you need to be careful and take a lot of care in how you structure your business entity. Okay, LLCs, which I set one up today. LLCs and S corporations and partnerships have a lot of tax advantages that are available to them to reduce your taxable income. But if you don't know about them and you don't know how to structure your business, then you can't take advantage of them. And then not every entity is the right entity, I should say, and not every structure is the right structure. So again, you need to have the right structure at the right time. You might start off with one structure and then at a certain period of time need to move to another one. But if you don't have the proper knowledge or the proper guidance, then you won't know, and that will hamper your growth. And then thirdly, if you're a business owner or investor and you want to get deeper or started or reposition or position yourself, you want to plan for long-term tax efficiency. Okay, plan for long-term tax efficiency, and what that means to me is um, you get the attention on your tax life, and then you become intentional in your tax life, and then you want to start to execute in your tax life, and you might have to and might want to hire a tax professional that can help you put a plan together, can help you make certain strategic moves, and then can help you to execute on the strategies and the tactics that you use. But you want to play the long game. And if you're not, let's say, if you're not of age to play the long game, then you play the game as long as you can. And if you play it correctly and make corrections and course correct, as they say, then you might not necessarily be playing a long game for yourself, but you might be playing a long game for your children or your children's children. Okay? Um, so the best time to start repositioning or position yourself and utilizing the tax code and the strategies and execution tactics is actually yesterday. And then the second best time to start to reposition or position yourself is now. Okay. Um, I'm gonna give you a couple more examples of how smart tax planning really benefits and saves people thousands. Got to employ. So let's go back to if you're a W-2 employee and you want to position yourself to start to take advantage of tax laws that are written in favor of business owners and investors. So I'll give you an example. This was a client that we had. His name was Jason, and Jason was a high earning client. I mean, high, you know, six figures, and he was paying a lot of taxes. So when he came to us, we sat down and we sent him and went through our financial questionnaire. And once the questionnaire was done, we had another council session, and we decided to position him to take advantage of the tax laws that were available for business owners and investors. He loved his job. He loved his salary, which was a great salary, which is a great salary. Um, but we wanted to see if we could derive some tax savings. So he decided that he was going to start a consulting business. He's a management consultant. He started a management consulting business. And in the first year of that business, he made about 10 grand. But when we tallied up all the expenses that we had calculated and coached him on and advised him to utilize and to leverage, the business actually ended up spending more on paper than he made on paper. So the business grossed 10,000, but spent 17,000. So he had a net $7,000 loss. Now some of you guys may think that that's a bad thing. And initially, when you look at numbers, yeah, losing money would typically seem like a bad thing. But in this particular case, if you guys know anything about business, if you've been in business, I'm just being real with you. Not every business make money. Not every business make money every year. And sometimes it's the owner's fault. Sometimes it's society. Sometimes it's the market. Sometimes it's the business that they're in. But in this particular case, in his consulting business, um, Jason ended up spending on paper, okay, $17,000 more than he made. Excuse me, $17,000 when he made 10,000. So that $7,000 loss um, was actually not a bad thing because it reduced his W-2 income by $7,000, thus reducing his taxable income, and he paid a lower tax year over year. Okay. Now the goal would be to eventually have this business make money, but initially, when you leveraged business expenses against the income, it went at a loss. Okay. But again, um, with the proper planning and execution, the goal would be to flip this business into a money making opportunity. And then you take that money that the business now makes and step your game up maybe into the investor or real estate investor category. Okay. And then the second example is Michelle. Well, I'll call her Michelle, but she's a real estate investor, and Michelle had a few properties. She had some property in a college town, and we were doing her taxes, but we were just acting in a capacity as a tax preparation firm. So, unbeknownst to us, she sold one of the properties that she had and did not let us know before she sold. And when she sat down with us to prepare her taxes, um, we calculated a big tax bill that was due to the sale of the property, and she had to pay capital gains about $40,000. And when I talked to her, I explained to her, I said, "Look, Michelle, you know, I really wish you would have talked to us because we could have advised you on a strategy that you could have used." Well, first I asked her, I said, what did you do with the money that you made from the sale of the home? And she said, well, I'm just sitting on it and I'm waiting on another investment. And I was like, oh my gosh, right? Anyway, I explained to her that if she would have came to us, I would have told her about Section 1031 exchange, in that if she would have talked to us first, we could have positioned her to take advantage of that law, and she would have to take a couple of extra steps to um, document the sale and document the fact that she was going to be looking to reallocate that money and those capital gains into a new property. But since she did not do that, and she did not do that in a timely manner, she ended up having to pay capital gains. But the next sale that she made, we were able to obviously advise her because she moved into tax planning, and we advised her about the 1031 exchange and how to get it done and how to, the steps that it would take to get it done. And she decided when she was going to sell the next property, which she sold the following year, because she wanted to move to Florida. But she took that property, took the sale of that property along with the proceeds and the capital gains, and she moved it into another property that was in Florida so she could manage it. But she was able to not have to pay capital gains, and then carry off what she wanted to, which was move from one property to the next, no capital gains. Matter of fact, the property that she bought was of higher value, so she actually moved into a situation where um, her wealth was increased because she went from a property one size economically and financially to a property that was a greater size, and now she increased her wealth just based on the value of the property. So if those are two examples of clients that we've had that once they had the proper instruction and guidance and learned how and were guided and taught how to execute it, when they executed, they were able to receive the benefits of the tax laws that are written in particular to take advantage of by business owners and investors. So a couple of final thoughts, all right? And this is my opinion, but in the United States, the government um, initially was supposed to have a laissez-faire kind of um, attitude. Laissez-faire means hands off. Okay, government just kind of was supposed to provide just basic services for the public. Security like the armies and military and certain services. And over time, our government, um, for different reasons, has become more. Um, I don't want to use the word intrusive, but more a part of the taxpayer's life. Okay, and in regards to taxes and a whole lot of other things. But the idea is that uh, the government does not want to be in the business of housing its citizens. Okay, the government does not want to be in the business of employing its citizens. At least it didn't want to be, and I don't think the current government does either. They want private individuals, private citizens, private taxpayers to house people or to provide housing opportunities for people, and they want private citizens to provide employment or work for the citizens. And so the tax laws that we're talking about, and the reason I believe that the tax laws are skewed toward business owners and investors is just to do that, okay? Is to give individuals that are risk averse or less risk averse and don't mind taking a risk to start a business or to buy some real estate and rent it out or to start a business and employ people. And the government says, okay, if you guys can do that, then we'll write the tax laws to benefit you and give you some advantages, what a lot of people call loopholes. But the government knows that they are not good at housing. The government knows that they are not good at employment. There's certain things that they may have to do from those vantage points, but they don't really want to do it. So they write the tax code to benefit business owners and investors, hope that they take their money and do just that. Start businesses, invest their money in the market, invest their money in real estate, provide housing for people, provide jobs for people, and then those jobs and those housing all create tax money that the government uses to run the military and things like that. So that's my spin on things. If you got a different spin on it, let us know in the comments. And I'd like to know what you think about it. But in my 30 years as a tax professional, and in my 62 years as a human being, and the things that I've learned over the years in my schooling, in my military career, my business career, my career as a parent, as a husband, the government writes laws in particular to take advantage or for people to take advantage of and utilize it. And then the hope is that they take some of the savings and reinvest back into the market, back into the real estate, back into the employment world, and basically just recycle those dollars for the benefit of the government, because otherwise we'd be a socialist country. And initially we didn't want that. And I still think that we don't want that. So at the end of the day, your tax life is a direct reflection of how you position yourself. Okay, I'm reading this, but you can keep overpaying, waiting for big refunds, hoping for the best when you sit down in front of your tax preparer, or you can take control, start using the tax code to your advantage, build a future that will allow you to keep more of what you make and to allow you to fulfill your dream. Again, we talk about what's your dream. And again, your dream could be your vision, your desire. What do you want to do with your life in the time that we have on this earth left? Do you want to leave money to your family? Do you want to leave property to your family? Do you want to give more while you're alive to people who have less than you do? Or do you want to vacation more? Or do you want to build your dream home? But your dream, your vision, your goals, they all can be made to happen, and maybe made to happen faster with a tool called money. And that's what these lessons are about. It's about utilizing tax law, planning, positioning, repositioning, using leverage to benefit you, to get more of your money back in your pocket so you can invest in your life, not necessarily your tax life, but in your life and what you want to do in the future. So appreciate you guys stopping by today. You got any questions, hit me up on the message. I appreciate the opportunity. Thanks a lot. And as always, I'd like to say, what's your dream?